And now it gives me great pleasure to welcome Adam Avigdori.
Thanks, Mark, and hopefully you can all hear me. And I believe, Amanda, you're controlling the slides. So if we start from the top, and let me introduce who I am on page 2. So my name's Adam Avigdori. Most of you probably won't know me, but I've been working at BlackRock in some form since 2001, and I've been running money since 2005. And I've been running this, the BlackRock Income and Growth Investment Trust since 2012. And let me tell you a little bit about the trust up front so that you know what it is that we do and a little bit about who we are. The trust is a UK focused investment trust. It's really focused on total return. So that is, the clue is really in the name. It's about combining, great income, but also with great capital growth. And it's really aimed at delivering a strong total return over the long term. So this is a trust that's ideal for people that are really looking to solve problems a little bit slowly. And the problem that we have decided to focus on is, I think, the problem that affects most of us, which is really focusing on creating a pool of capital really for retirees and making sure that we compound, small increments of performance over a very long time. And we think that's a very, very powerful measure in combating some of the, obviously, the long-term liabilities that we're all exposed to. And really how we do that is by focusing on the UK market and really by looking at trying to find the greatest income and capital ideas really within the UK market. Some other points that you should know: we have an active discount control mechanism in that, which is supported by our broker, JP Morgan, and we are a member of the UK equity income sector. So let me tell you a little bit about the team that sits behind me. I think one of the difficulties that we always have when you speak to fund managers is you rarely see the people and the resources and the work that goes on behind us. And if we go to slide 3, Amanda, what I show you on slide 3 is a picture of the wider UK equity platform. So these are all my colleagues who help me and really help the trust find those great ideas. And the way we really do that is by focusing really on meeting company management. And we spend a lot of time meeting not just the executive teams, but the teams that are underneath the executives, but also the board members and other members of the executive team as well. Not just in the operational sense, but also in sustainability as well. And you can see the wider BlackRock research platform does well over 15,000 meetings a year, and we do somewhere between 1,000 and 1,500 meetings every single year. So we spend a lot of time with companies, and that is really what helps us define what we believe is going to happen, helps us anticipate what's going to happen, but really helps us understand what's going on within the corporate and consumer world with regards to behaviors and really identifying those advantage businesses which we think can generate sustainable profits and growth over a very long period of time. They are very, very powerful share prices and corporate investments. So if we move on to slide 4, to tell you a little bit about our philosophy, and really this is the foundation stone of our philosophy, and we call it true valuation. And the true valuation is never actually the earnings of a business, it's the cash flow. The cash flow of a business is really what makes the world go round. It is the thing that pays the bills, it's the thing that you can invest, it's also the thing that allows you to pay dividends and to grow the dividends over time, which is really, really important. So we really focus on free cash flow in the most sustainable fashion. And what we mean by free cash flow is it's all the cash that's generated by a company after it's spent what it needs. And what we mean again here is companies have lots of requirements to spend money. They've got to keep the lights on, they've got to keep the people employed, they've got to make sure that they're investing appropriately. And what we're doing is working out what cash flow they have left after all of those needs have been satisfied. And we try and understand how that cash flow develops over time. And the way we do that is to try and analyze what it is about that company, whether it's a technology, a product, a management team, a geographical position, whether it's IP, whatever it may be. We try and identify what is the competitive advantage that allows that business to generate free cash flow over a very, very long period of time. And when we talk about a long period of time, really the analysis starts between years 3 and year 5 and goes beyond that, because ultimately what matters here is what companies are doing to sustain it in the very long run. And that's really what we focus on. So free cash flow is the sort of cornerstone of our valuation framework, and it is what we base the vast majority of our analysis on. It is also, and happens to be, very, very important, particularly when times get tough. And what you will find about us as fund managers and perhaps the trust is that when when the world gets a bit tough, as it did in 2008 or it did last year, free cash flow is really important, because if you are able to generate free cash flow in a difficult world, you're able to keep the lights on, you're able to invest through the cycle, and it means that you typically come out of dangerous and difficult situations in a much, much better place. So when we talk about a measure of resilience, what we mean by that is that companies that can generate free cash flow tend to perform better through the cycle, but most importantly, they're able to perform better when times are very difficult. And the last thing just to say on this slide, the one other thing that you should know about us is that we truly are style agnostic. And what I mean by that is that we invest across the market cap spectrum. We are not growth managers and we are not value managers. We believe that there's all types of companies that present opportunities for income and growth. And we like to keep ourselves as investors as open-minded in our approach to those businesses. So what we try and do is not to fixate around the price earnings ratio in any given year. What we're trying to do, again, is to work out what the free cash flow is, what the starting valuation is, and whether or not that free cash flow has been accurately discounted by the equity market. And in most cases, the answer is usually no. And that's where our opportunity as stock pickers comes to fruition and comes to the fore. So let's talk a little bit about, having told you a little bit about the philosophy, let me tell you about the portfolio and how we apply that free cash flow mentality into building a portfolio. And we really split the portfolio into 3 separate parts. The foundation stone of the fund is something we call income generators. And these are really businesses that are generating sustainable free cash flow, and they're allocating that cash flow between investing and growing their own business, but they're also allocating a large portion of it to shareholder returns. And this typically finds its way back to us in the form of dividends, or indeed in some cases, buybacks. So these typically tend to be duration businesses. Reckitt Benckiser is a good example, a consumer staple with very, very strong franchises in health and hygiene, or something like a Relex, which is a business which has been around for a very long time and has generated growing free cash flow virtually for every year in the last 20. And what we're trying to do is find businesses like Relex and Reckitt Benckiser, where we believe the management team have done a good job investing in it, and we can harvest that cash flow over a long period of time to sustain, a good starting yield, but also a very strong growing yield within the portfolio. And then what we do with that foundation stone is we ally it with 2 very specific types of company. One is growth companies, the other is turnarounds. Dealing with growth companies first, these really are companies where we see their advantage over the long run to be significantly in excess of their peer group, and as a result, those are typically businesses growing faster than the industry they're in, and or taking market share as well from their peer group. And they're doing that because they have advantaged themselves either through investing, through IP, through technology, service, or even indeed a geographical position. And typically these are companies we think can grow double digit. And here the free cash flow is really focused on making sure that company continues to grow, where the white space opportunity or the growth opportunity is significant. And it's far, far better for those companies not to give all the cash back to us in dividends, but to allocate a larger proportion of that free cash flow into growing the top line and ultimately growing the cash flow. And in a way to think about this is these are the companies that in the future will be very, very strong dividend payers, where dividend growth here is also very strong, but it's starting from a much lower base. And a great example actually today is 3i, which had fantastic results today. It's a private equity business with various investments all over the world, but primarily European focused. Its largest investment is a business called Action, which is a value retailer, typically on the continent across Europe, has just recently launched in Italy. And they have grown their NAV, their net asset value, in the first half of this year by nearly 22%. And that business has, that share price is up approximately 25% year to date. And we think it's a very advantaged place. But again, they are using the free cash flow and the cash flow they're generating to grow those businesses rather than to pay us large yields, although the dividend yield continues to grow very, very nicely. Another example here is Electro Components, which is a distributor with more than 2 million SKUs, which is really focusing on that sort of B2B Amazon-like distribution model, where companies are effectively using their catalog and their ability to source product to grow their own businesses and to fulfill their own product cycles. And that again is a business growing very, very strongly, double digit, relatively low yield today, but growing very, very nicely, extremely strong balance sheet, and again, fantastic free cash flow conversion. And then what we do on the right-hand side of the portfolio, which is sort of, I guess, the unique, the sort of more unique part of this portfolio construction, is we allocate a very specific amount of money to something that we call turnarounds. And these are companies typically that are dislocated for a cyclical reason. So in the short term, something has happened which has caused their share price to fall, but we believe that at some stage that cyclicality or that problem will resolve itself, and the free cash flow capability of this business will again assert itself over time. And this is probably the riskiest part of the portfolio, which is why it is the only part of the portfolio that has a hard limit. And that's to say that only 10% of the portfolio can ever be invested in turnarounds. Whereas obviously income generators and growth companies move around as the opportunity set differs. So we believe this flexible approach is the perfect way of capturing, the best ideas that come out of our team, but also the best ideas in the market. So if we turn over the page to the performance of the trust, you can all see both the annual and the performance over the last 5 years. Certainly a more tricky year this year, definitely a fantastic absolute performance, but has been very, very strong equity markets this year, which we have not been able to keep up with, but still delivering that strong absolute return. And the other thing to say is that the dividend this year has been, I guess, a little bit more successful than we were hoping in the trust. We are definitely slightly ahead of where we thought we would be 12 months ago, with the dividend payers coming back to the market, and we'll talk a little bit more about that in a little bit. So one last thing to talk to and highlight on page 6 is ESG and sustainability and how we think about ESG investing. Amanda, if you could turn the page, one more page, sorry, to page 7, sorry. I guess the point to make about great investments is that when you're in a great investment because they are operating within a healthy ecosystem. And what we really mean by an ecosystem is where a business or a corporate is treating all stakeholders fairly. And what we mean by that is stakeholders such as the employees or the customers or shareholders, bondholders, pension trustees. It's really about making sure that you're maximizing profit by using sustainable behavior. So you're not overcharging customers, you're paying fair wages, and you're ensuring that the ecosystem in which you are selling your product, you are developing your product, and you're innovating your products is a healthy one. So combining great financial behaviors with those great corporate behaviors as well. So if we move over to the macro and maybe talk a little bit about, what's been going on. Certainly there's been a lot going on, and we expect that will continue over the next few years, but worth just alighting on some topics that are, I guess, pretty interesting at the moment, and are certainly creating a lot of conversation. So if we go to the next slide, Amanda, we'll start with I guess the last 2 years. And I guess the first thing to say is, we're moving out of the COVID crisis, I guess, into the COVID era. I think it's very, very early to sort of call the end of COVID. I very much expect that there will be still quite a lot of volatility throughout this winter, despite what are looking like great vaccination rates, particularly in the developed world. But we are still not quite out of COVID and COVID impacts. So we are building a portfolio, still one thinking about resilience, still one thinking about the potential downside scenarios that you can have and can occur. And I think probably we should remember, and certainly when we're doing our analysis, just how strange the last couple of years have been. I mean, it has been a very, very, very unusual period in terms of consumer behavior, in terms of corporate behavior, and indeed in terms of some of the government expenditure we've seen. And we should just be cognizant that as we go through the next 2 or 3 years, some of the after effects of COVID, and we're seeing them today with the supply chains and inflationary backdrop, some of the after effects of COVID will still be having some very, very significant impacts on the corporate and consumer world. And we should remember in our analysis and in our cash flow expectations that it is not a straightforward analysis. There's still potentially a lot of volatility to come and potentially a lot of normalization to come. And that's going to have different impacts in different sectors. And we'll talk about that a little bit later. So the backdrop, generally speaking, is a bit more confused. It's a bit more uncertain. Having said that, the initial resurgence or reopening in terms of people returning to work has been good. Unemployment levels have been relatively stable and sound, which is good to see. And global manufacturing, although, as you can see, has had a very, very volatile 2 years, is starting to stabilize and still remains in absolute terms at a pretty healthy level. So if we turn over the page to the next slide, I think one of the things that we should be cognizant of and remember is just how significant the investment, the interaction, the intervention of governments globally has been. In the UK, we now know that more than £400 billion have been spent supporting the UK economy, and that represents more than 21% of annual GDP, which is just an extraordinary number and dwarfs what happened in 2008. And that same picture, you can copy and paste it across the world, whether it be in continental Europe or the US, and particularly in most developed markets. And the one thing to just remember is that we should think about how much the COVID crisis has cost the UK economy, but the global economy, and how much we've mortgaged the future to pay for the present. And what we're seeing as we go through 2021, but also likely in 22 and 23, is not just the support being removed from the market, but also there's going to be some taxation and some ways for governments to claw back some of that money. We're seeing that in the UK and in parts of North America. And clearly, if Joe Biden is successful with his, not just his infrastructure plan, which he's been very successful with as of last week, but his taxation policies, we will expect to see a bigger government take in the US as we go through next year. And that means that the headwind of credit impulse, so the tailwind of credit impulse is becoming a little bit more of a headwind, and central banks are starting to withdraw some liquidity from the market. And what we expect that will mean for us is greater dispersion. It means that the the very, very high correlations we've seen between asset classes is going to change. And we expect to see greater dispersion between asset classes, so between equities and bonds and property and other asset classes, but also within asset classes. So from a stock picker's point of view, I think that's a great backdrop for us, a real opportunity for stock pickers to pick some very, very strong winners. But we should be mindful that we are in a very different picture going forward as we have versus what we've seen in the past. And that sort of normalization picture, if we go on to the next page, please, Amanda, we've seen that in consumption. I mean, look at that slide on top left. And what this shows you is that historical trend of US consumption, which is the dotted line, and the absolute consumption. And you can see just how incredible that March-April period was in 2020, where consumption collapsed and then rebounded incredibly strongly as furlough schemes kicked in. And now we're in a period where consumption is starting to normalize. And that's going to have a big impact for lots of consumer-facing businesses, because it is going to simply mean that the wallets that you are trying to win over are probably going to be slightly down rather than slightly up. And certainly within those wallets, there's going to be more competition. You know, if you think about 2020, there were a number of things that consumers could not spend money on. For example, holidays. So a lot of that expenditure went on other discretionary items. You know, people bought more expensive food, they bought more expensive wine, they spent more money shopping on the internet. And as we move forward, a lot of those trends are going to normalize, and that's going to have big impacts on many, many businesses. The one thing that I would say is that the backdrop for consumer balance sheets is very, very good. You know, most people, if we look at savings ratios, have been able to save money over the past 2 years, which is incredible to think about that today versus where we were in March and April, which we were very worried about savings and consumer balance sheets. But generally speaking, consumer balance sheets are in a good place, which means that people will have money to spend. And the real question here is what will make them spend those savings? And for us, it's about consumer confidence, about job security, about wage inflation. All of those items are really going to be really, really important for us to monitor as we go forward. So if we go on to the next slide, the next slide, and then perhaps if you go on to the next slide after this, sorry, Amanda, in the interest of time, just to talk really about the UK market, which I think is really, really important, and to look at valuations. Now, I feel a bit like a broken record, as for really the last 6 years, every time I do this presentation, the UK market seems to get cheaper. But as you can see on both the top, which shows that the Z-score, which is a sort of combination of valuation measures over time, bottom left, which is the price earnings ratio, bottom right, which is the UK price earnings ratio. Even if you include things like financials and others, the earnings ratio in the UK is really at very, very, very low levels. And what this is saying is that the UK market's just very cheap. It's probably one of the cheapest global developed markets. And that picture, I don't think is sustainable. I do believe if you think about the 80% of UK earnings which are overseas, there are vast, vast areas of UK market that typically trade at very large discount to their peer groups overseas, whether those be in staples, industrials, or pharmaceuticals. Those are businesses that are identical to these companies in many ways. They just happen to be listed on the London Stock Exchange or in the UK market. And I do believe over time, that is a massive opportunity for stock pickers taking advantage of some of these really depressed valuations. And if you look on the next slide, you can see that that sort of arbitrage is happening. You know, the UK has seen a very, very strong backdrop of M&A, private equity in particular, but companies outside the UK really like investing in the UK. They like buying companies in the UK. And they like buying companies in the UK, not just because the valuation is very cheap, and clearly they are making a lot of money out of that arbitrage, because if you don't value something correctly, someone else ultimately will take advantage. But they're doing it because they have a real trust in our systems, whether that be the accounting measures that we have in US and UK GAAP, whether it's the legal framework, whether it's ubiquitous and language and English, and whether or not it's good duration, high visibility businesses, and really a government that doesn't have a high protectionist policy or large amounts of stakes held by families or others. So it's a great place for private equity and other companies to go shopping, as they have done over the years. I remember over 20 years ago, used to have, when I started, lots of infrastructure investments like ports and airports, lots of different non-life insurance companies, lots of bus companies. They've all pretty much disappeared from the market as they've been acquired over the years. So the backdrop for investment, I think, is great in the UK, and the valuation, I think, is a great part of that. So in the interest of time, perhaps if we just go to slide 16 and 17, I'll just finish on dividends, then really anxious and hopeful to open it up to some questions. The thing to say, I think the one silver lining of COVID, which is really important to remember, is the dividend picture coming out of COVID, I think, is incredibly healthy. And in fact, I think the dividend picture coming out of COVID has really been probably the biggest benefit of what has happened to the corporate structures in the UK, much of which has been obviously pretty damaging in terms of some of the lost revenues and clearly some of the difficulties in corporates managing employee workforces and innovation and product cycles. But what we have seen is the UK market emerge with a far broader dividend yield, a far deeper dividend yield, and I think a much better covered dividend yield, which can grow faster. And we remain, again, one of the highest, if not the highest, developed market yield. And we do believe that as we come through this, we're going to be in a great position to capture lots of that dividend, to grow dividends, perhaps faster than we otherwise would have done. And as I alluded to earlier, we've definitely, I think, surpassed our own expectations this year in being able to capture more yield than we thought. I think the corporate picture has been better. Companies have been more anxious to come back to the dividend market quicker than we would have thought, and they're definitely paying out more than we would have thought. And we've benefited in the portfolio some very big special dividends, in particular from the mining sector as well. So, in a good place from dividends as we go forward, on top of the very nice revenue reserve we have, we feel like we've got a great foundation to grow that yield over the medium term. And I propose stopping there in the interest of time and opening it up to Q&A, Mark, if that works for you.
Thanks very much. Very interesting presentation. As Adam says, we're now ready to move on to the Q&A. And I believe that Charlie Kilner from BlackRock's Investor Relations will also join us if there are any investor relations related questions. If you'd like to unmute yourself and turn your video on, Charlie, you can join us. Whilst Charlie is joining us.
The camera's warming up. There we go.
Right.
Evening, everyone.
Good evening, Charlie. We have a couple of questions which were submitted in advance. The first one is, how do you integrate ESG factors into your investment process?
Yeah, so it's a great question. And I talked a little bit about this, but to give you more detail. So when we think about ESG, really what we're trying to do is ensure that the corporates that we are investing in are doing the right thing, not just for us, but the right thing for their ecosystem. And what I mean, again, by that is to say how they're treating customers, human capital, making sure that they're paying the fair wages, how they're treating the environment around them. So we spend time with the sustainability teams for all the investments in the portfolio. We spend time and meet the boards of all the portfolios regularly. And really it's about ensuring that the behaviors are correct. And just to be very clear, ESG risk is financial risk. So making sure that the reputational risk, some of the behaviors are aligned, and making sure that the company is doing the right thing in the long run. Now, that's not to say that everyone looks great on day one. We recognize that companies are in different stages of their ESG journey. Some are very new to this. Some are private businesses coming to the public markets and are very new to this. But what we try and do is make sure that we're engaging about behaviors and about what we want to see over the medium to long term. And we really want to make sure that those companies are on a journey to improving disclosure, improving behavior, and making sure that they understand that the ESG risk is financial risk for the sustainability of their returns in the long run.
Thanks very much for that comprehensive answer, Adam. The next question that we've had submitted was, does Brexit matter and how does it feature in your investment analysis and company meetings?
Does Brexit matter? If I'm honest, Brexit does not matter. If I'm truthfully honest, I think it matters for a very, very small part of the UK listed economy. If I'm truthful, the vast majority of companies in the UK today, over 80% of them are international businesses with vast networks of customers and suppliers across the world. And they may have headquarters in the UK, but they'll have facilities all over the world. So it doesn't really affect us on a day-to-day basis as much as I think a lot of commentators have made out of the last 4 or 5 years. Obviously, there are sectors like retailers, domestic earnings businesses, which have an impact. But one of the things I think people don't appreciate about Brexit is, a lot of the planning that went into Brexit actually really benefited a lot of companies as they went through the COVID crisis, because the COVID crisis was all about supply chains as Brexit was, and it was all about trying to make sure that you had integrity in your systems, which is what Brexit was about as well. But the reality is the impact of Brexit in terms of the portfolio has been, relatively minor. We've never really spent a lot of time focusing on it. We've spent some time with companies going through some of the emergency plans, but the reality is the vast majority of our portfolio is really about what's going on in the global economy, far more about than what's going on within, specifically just UK economy, but also specifically in terms of just the trade agreements between the UK and the rest of the world.
Thanks again, Adam. Now we move on to questions from delegates here present. Top of the list is one from Anthony Ross. Do you feel that your trust offers inflation protection for investors, and if so, how?
Well, I don't know an asset class that's got better inflation protection than equities. Truthfully, I think outside of obviously government index-linked bonds, equities are an incredible inflation hedge. I think from our point of view, how do we make sure that we are beneficiaries of inflation rather than having inflation detract from performance? And that comes down to making sure the companies that we own have pricing power. If you have companies that can price inflation and price above inflation, inflation environments can be very, very powerful tailwinds to both cash flow and earnings, because it gives you an umbrella to push pricing in a sustainable way. As long as you're innovating and investing and bringing genuine services and genuine market-leading products, then you usually have great pricing. So inflation is no bad thing as a whole. Bouts of inflation can be terrible. I think the biggest risk to any asset class is very sudden, very aggressive inflation. But inflation trending over time typically tends to be positive, not negative. So yes, I think we're in a good place. I think the asset class helps us, but certainly the way that we think about companies and the way we invest in companies and how we interrogate the investment thesis around companies should help hopefully protect unit holders over the medium to long term.
Thanks, Adam. Next, I'm going to combine two questions from Craig Thompson and Matthew Ellis, as they're closely related. Craig notes that the trust is quite small at around a £40 million market capitalisation. And as both he and Matthew say, it means that your ongoing charges are relatively high at 1.2% according to the AIC, compared to a number of other trusts that Matthew mentions, which have lower OCFs aided by their larger size. Matthew also comments that those trusts outperform you on share price and dividends, and asks if you'd like to comment on that and what you might be able to do to grow the trust to address how the costs can be better absorbed.
I'll start. I think that's a really great question. I think Charlie should also take that question as well. But from my point of view, I think that the most important thing that we can do is to make sure that we drive performance. We make sure that we continue to evolve and be relevant to shareholders. And I think we attract people to the trust over the long term. I think the backdrop to UK, I guess, investment trusts, or certainly the UK income sector, has been, I think, a pretty difficult one in the last 3 years. The vast majority of people that we speak to, generally speaking, are much more focused on growth. Equity markets going up at 10 to 20% every year. You don't tend to go for resilient income trusts. You tend to look at other sectors and perhaps other investment trusts. But I do think for those that are looking to combine total return and part of that being the income over the long run, we're going to be a very, very compelling portfolio trust. But it's really my job and David Goldman, my co-manager's job, to make sure that we come across and we make sure that we make that argument consistently and coherently until we get blue in the face, or I'm willing to die at the altar trying. But I do believe that over the long term we will attract people to that mentality. Performance over the long term will be good, and we will drive dividend growth over the long term as well. I don't know, Charlie, if you have any comment on the size in terms of the costs and
yes, I mean, I think it's a perfectly fair comment to make, and we can't hide away from it. In terms of trying to address it and gain better economies of scale, obviously that's through growing the trust. And two ways of really doing that is by issuing shares. And to do that, we would need to get to a premium. You'll note that the whole of the UK equity income sector, I think, is trading at a discount. So as Adam mentioned, it's as a sector, it hasn't been as favourable over these sort of recent strong markets. And the other way to address the size is through corporate activity, and it's something that we'll always look at if opportunities come our way. The board are fully aware of the size issue. The chairman will often liaises, makes himself available for shareholders for comment and feedback. And certainly if opportunities come along and we think it's appropriate for the trust and the board wish to pursue something, then an announcement would be made to the market, and we would look to grow the size of the trust through corporate activity.
Thanks for your straightforwardness on that rather tricky question. Great. Next, we have another question from Anthony Ross, who notes your focus on free cash flow in the presentation. You didn't say anything about balance sheets. What are your views on corporate debt and gearing in your investment filters?
Yeah, no, it's a great point, and forgive me because I should have talked about it. I mean, hand in hand with free cash flow typically goes with the appropriate balance sheet protection that comes with that. And as a fund manager, whose first day in the office was actually September the 10th, 2001. And the first 3 years of my career was really about balance sheet protection. I'm very, very sensitive to that, and I always make the point that balance sheets and free cash flow typically don't tend to matter for most of the time, but when they do, it's the only thing that matters. And that's why during difficult times, we typically tend to do quite well because of that religious focus on leverage, that religious focus on free cash flow. Simply, we like strong balance sheets. That's not to say they all have to be in net cash, but we want to make sure the most important thing is that even when times are tough and debt markets withdraw funding or equity markets withdraw funding, that the business is able to fund itself through its own free cash flow and is able to make the right investments. And I guess as most people know, the greatest investments typically happen when others aren't making it. That's where you can make really, really strong progress against your competitors because you're able to spend the money when they're not. And a lot of our work really does focus in on that. So, when we are stress testing portfolios and companies, we're not just thinking about what's happening in the market today. We're thinking about what could happen. And if it does happen, what would happen to our equity or our company or our share price? And it's a very good point, Anthony, and one you'll forgive me for not mentioning during the presentation.
Thanks very much, Adam. Helen asks a question about the performance of BRIG relative to other UK income trusts. And I'd also add to that and ask if there's anything you feel you can do to improve performance going forward.
Well, I think if we look at the longer term performance, we have out the 5-year number, we've just dropped out a very, very strong year in 2015. And obviously year to date has been weaker than we would like. Let's be frank about it. Definitely, we were expecting, I guess, probably a more difficult year for companies. We thought that some of the issues of COVID, indeed, some of the issues that we're seeing now would be more prevalent earlier in the year, and some of those animal spirits would die down. But it's been an incredibly strong total return from the stock market this year. Although we're actually pretty happy about where the portfolio is, it's definitely lagged some of those stronger animal spirits, and typically definitely some of the more leveraged names in the UK market. But what can we do? Listen, the reality is, what can we live and die by the companies we invest in. I think a number of our corporates are poised for very, very significant performance as we go through the next 1, 2, and 3 years, because they've been doing the right things during COVID. And I think as the world normalizes and some of the COVID effects wear off, I think the quality of what we've invested in, the management teams we've invested in, are going to become a little bit more obvious. And as the tide goes out, I think you'll find the vast majority of our portfolio will be stronger and much better positioned as a result of the last 2 years than prior to that. And I'm very comfortable, very confident that we're investing in a number of names where I see very, very significant upside over the medium term.
Thanks, Adam. Matthew asks a bit of a personal question. Are you invested in BRIG yourself, Adam?
Yes, I am. As indeed my family are as well. Yes, it's a great question, Matthew. I'm a very large holder in BRIG, and part of my remuneration is paid into shares in BRIG directly as well. So I am very much aligned as a shareholder. It is a very large personal holding, as is the open-ended fund I run as well. So yes, the answer is yes, and I don't think I could honestly ask others to invest in me if I wasn't willing to invest in myself. So perhaps I'm not clear about that, but I always think it's important for fund managers to be invested alongside the people they're asking to invest with them.
Yeah, I think that's very much the view of our members as well. So we're delighted to hear that case of putting your money where your mouth is.
Exactly.
Great. Next question is from Jay Shah. If I'm understanding his question correctly, I think what he's asking is that there have been a number of new REITs launched recently. I think there was a healthcare one. Did you consider any of those as worthwhile investments?
The short answer is no. It's not to say I'm not interested. I don't. There are typically some vehicles that I like to invest in, but generally speaking, my bias is not to buy other fund management vehicles to pay fees upon fees. I'm really looking generally to invest in companies rather than other trusts. Now, 3i is actually a trust, inverted commas, because it's a collection of vehicles. So that's the only exception. But again, that's not, they're not charging me a fee to be an investor in that. That's a share. So it's not quite structured in the same way. So no, generally speaking, the answer is typically no. I try to find yield in sort of the corporate world rather than in the trust world as a general rule.
Thanks. Then Anthony asks another question. How important do you think moats are to the investment case for a company?
Well, it's everything. I mean, Anthony, you're asking some great questions, so thank you. It's everything. Listen, if you think about every single investment we make, the key determinant of whether or not that will be a successful investment is whatever that company is doing or about to do, they're able to sustain it. And the only way anyone can sustain anything is by making sure that they are the only people or one of the few people that could do it. So we analyze technology, we analyze the sector, the peer group, we analyze IP, we analyze human capital and skill sets and geographies and market shares. And moats can be created from lots and lots and lots of different things. It can be created from regulators and governments. It can be created from human capital, and it can be created overnight, and it can take 30 years to create. Relex is a great example of that. It's taken 30 years and longer to create. Reckitt Benckiser has been around for decades. It's taken years for them to create that cash flow. So we focus on making sure whatever they're doing or about to do can sustain itself, and that analysis is all about the moat.
Thanks. I'll just remind people, if anyone else would like to ask a question, click the Q&A button at the bottom of the screen. In the meantime, we've got one or two other questions that were submitted before the webinar. Where are you most excited or most worried?
Oh, good question. How long do I have? Where am I? I'm more permanently worried.
Got about 5 minutes.
Yeah, so I'm always worried. I think as a fund manager, and having been doing this for a long time and seen financial crises and the Euro crisis and the Middle East Spring and some of the consumption and the democracy issues that you've had across the world, and then you've had COVID, and beyond that, there's always issues like a tsunami hurting, unfortunately impacting the coast of Japan and making a big impact in terms of some of the businesses and manufacturing sites we were invested in there. There's always things happening. The one thing I would say is the world is such a connected place these days compared to when I started. You really have to have eyes in the back of your head with regards to the global economy and also global behaviors. It really matters today what China does. It matters today what the US does. It matters today what consumers across the world are doing. I think I'm sitting in a great seat because BlackRock, as you know, is a big place, and we've got lots of smart people across the world who are feeding into to my information and our analysis. But if there's one thing probably I'm worried about, the thing I'm worried about the most is, I think in particular, a lot of consumers have been very, very hooked on government support. I think one of the most intriguing things of the last 12 or 24 months, particularly in the US, which does not have a benefits culture, does not really have a safety net. The government does not typically have the same infrastructure for their citizens as we benefit from here, like the NHS or state education or others. In the US, people got money put in their bank accounts for the first time in history. It happened a little bit in 2008, but really that's a drug, and politicians know that that's a great vote winner. And I suspect it will not be the first time that it will happen, because it's something that usually people like. And typically, once something has been done once and people know they like it, they'll carry on doing it. And I worry about how federal and government balance sheets develop, how consumers develop and withdraw themselves from that drug and support themselves. And I do worry about that withdrawal of government spend, because it's been such an amazing tailwind, such an amazing provider of liquidity, and that does concern me. The thing I'm most excited about is the other side of that. It's the dispersion that's going to come. One of the most frustrating things, I think, if you speak to a multi-asset manager in the last 5 years, is that so many of their assets are correlated, whether it's been Bitcoin or equities or bonds or property or stamps or physical assets, whatever it may be, they've typically all gone up or down in the same fashion. And that's very frustrating when you're trying to build a diversified portfolio. And I do think that's going to stop. And some of that dispersion is going to scare people, but I think it's going to be great for investors like myself, because there's going to be a real opportunity to create alpha performance between identifying the good and removing the bad. So long answer, but hopefully it's answered it.
That's great, Adam. Thanks very much for a very, very interesting presentation, and thanks, Adam and Charlie, for your great answers to all those questions. We look forward to welcoming you back in the future.
Thank you so much. Thanks for having me, and thanks for all the questions, everyone.
Thank you, Mark. Thanks, everyone. Good evening.